Ladies and gentlemen, let me also begin by thanking our hosts for the organization of this summit and the opportunity to get together and discuss these very important issues today. As Mr. Kalfin stated, I represent the Black Sea Trade and Development Bank, a sub-regional multilateral development bank headquartered in Thessaloniki and dedicated to the promotion of economic development and regional cooperation. We are a wholly locally owned entity by our 11 shareholder countries in which we finance operations and projects. We have a growing portfolio currently at 1.2 billion euros and a strong track record of profitability. I would like to approach our topic of infrastructure by looking at the issue of investment. To understand the region today, one needs to understand the economic and political fallout of the 2008 global financial crisis. The crisis is crucial because it brought a sustained period of high growth to a sudden halt. Growth rates from 2010 to 17 have been less than half the pre-crisis rates from 2000 to 2008. And moreover, the performance has diverged in terms of individual performance, as well as following different economic and business cycles. Infrastructure investment needs are enormous in the Black Sea region, with prevailing estimates implying requirements on the order of around 150 to 200 billion US dollars, amounts equal to a daunting 4 to 6% of GDP. That's on an annual basis. However, public and private investment in the countries around the Black Sea region has been weak since the crisis. Investment growth that was routinely in double digits has dropped to low single digits, and foreign direct investment numbers are just as bad, 50 to 60% off the previous decade's levels. Financing appears to be plentiful and available at historically low interest rates, but investment remains disappointingly low. Yet rates have been low only for those with easy, unfettered access to foreign currency borrowing. Domestic interest rates have been much more volatile, as national monetary policies have sought to juggle competing imperatives, such as stimulating growth, fighting inflation, supporting the currency, and stabilizing the financial system. Additional factors detrimental for public and private investments include heightened risk aversion, limited demand in traditional export markets, low domestic savings rates, uneven confidence in local financial systems, and a pervading sense of uncertainty, along with an underlying fear that markets may shift suddenly or even shut entirely. Access, or more accurately, sustained access to financing is a key post-crisis period issue. It is not only interest rates that are low, so is confidence. Put differently, country risk returned with a vengeance post-crisis in the region, and it often overwhelms the underlying economic fundamentals, which are actually quite solid. Which brings us to the political dimension that includes concerns about the international trade regime, as we've seen in the latest news reels over the last couple of days, the conflicts in the neighboring Middle East, spillovers from European turbulence, such as Brexit, for example, stresses on emerging markets caused by the riddle of if or when US interest rates might rise, and most perniciously, the resurgence of disputes between Russia on the one hand and the EU and the US on the other. These disputes have left the Black Sea region on the front line of a conflict that involves sanctions and counter-sanctions. It is a low-trust, high-uncertainty environment that is not conducive to undertaking initiatives to enhance cooperation or to deepen integration. Post-crisis public policy in many of the countries has been geared towards preventing a repeat by reducing vulnerabilities. Things such as borrowing less from abroad, building reserves, and reducing imbalances. However, in the same way that less risk results in less reward, less opening of an economy to external financing leads to less investment and growth. I cannot underscore enough what a problem this is. Infrastructure investment, both publicly and privately financed, is vital, both to boost current economic activity and to enhance the future growth potential of economies. The long-term costs from foregone current growth and lower potential growth rates are high and could have severe political implications, affecting living standards, demographic trends, migration movements, unemployment, and social stability. So what to do? A good place to begin is by recognizing that cooperation is a key part of the solution, something that others have also stressed in this panel. And its absence carries high opportunity costs. Enhanced regional cooperation projects projects favorable images and may create self-perpetuating positive externalities. Good beginning points include win-win activities to tackle common environmental challenges or to overturn negative perceptions of the region. Coordination among governments, and especially their regulators, can reduce transaction costs while boosting investor confidence. Such initiatives do not necessarily require much money, but they do require political will and trust. Similarly, countries can reform their business environment, strengthen financial sectors, and keep key macroeconomic indicators in good shape, measures which not only help the reformer, but may spill over to enhance regional perceptions and reduce contagion risk. The European Union, for its part, can contribute by sending powerful signals that galvanize private investment in this respect. In this respect, the objective to accelerate membership for the Western Balkans is very welcome. And while the EU still refuses to extend such perspectives to genuinely interested ex-CIS countries, it should extend the four freedoms as far and as extensively as possible. It can also build credibility by sincerely supporting local regionalism rather than trying to run things from Brussels. Official and multilateral sources of investment cannot fully make up for the observed decline in private financing. However, development banks such as my own are well suited to help investors mitigate country risk issues and mobilize resources in periods of low confidence. Indeed, development banks have played a significantly greater role in mobilizing and investing financial resources since 2009. They've taken on greater degrees of risk and responded to local needs in order to encourage investment. The surge, for example, in local currency lending is one such instance. But we need to look at new ways to mobilize additional external resources and to explore more ambitious pooling arrangements, the common denominator being to combine resources and risk-sharing capacity in order to mitigate the political and country risk aversion which has so negatively impacted investment. French President Macron was absolutely correct in saying recently that we need more, not less, international cooperation. It is especially true at the regional level, where one needs to work with neighbors to resolve disputes, to deal with common problems, and to build interlinking infrastructure that facilitates economic activity, enhances efficiency, and reduces transaction costs while sending positive signals to businesses interested in the region. Thank you.